Dear friends, welcome to the December edition of Monthly Viewpoints. The month of November for the Indian markets were lackluster. First, the numbers. The large cap Nifty index was down 1.1%. However, risk on was still on as the mid cap and small cap indices have clocked returns of 1.6% and 1.9% respectively. The bonds also backed up by almost 20 basis points during the month. The currency, the Indian rupee as well as gold were flattish during the month. In terms of flows, the FIIs had an inflow of almost $2.95 billion during the month, taking the year-to-date number to $8.7 billion. The DIIs, among them mutual funds, were net buyers at $1.6 billion, whereas the other DIIs were net sellers. During the month, there were two big news. The first big news was from Moody's, which has upgraded India by a notch from Baa3 to Baa2. This is a big deal because the rating upgrade has happened almost after 13 years, and it will help the companies from India who are raising money abroad to get money at a cheaper rate. The second big news is that of GDP recovery. We have seen after posting 5.7% GDP growth in the previous quarter, this quarter has seen the number of 6.3%, which we can safely assume that the trough is in place and we can see growth going forward to an extent of almost 7.5% in the next few quarters. The Brent crude has seen a rally of 3.6% in the month of November, adding to the rally of 25% which is seen in the last 4 months. That is causing a bit of jitters to the markets, especially the bond markets. The bond markets are also facing jitters from the increasing inflation numbers, both in terms of CPI as well as WPI, which has seen an increase of 30 and 100 basis points respectively to clock 3.6% for the month of October. On the global front, the focus was particularly on the United States, as Donald Trump was able to manage his first promise probably after getting elected to go through, which is the tax cuts in both the houses of Congress, and now tax cuts is a reality in the United States. It could be a huge fiscal stimulus, and economists worry that it is coming at a time when the unemployment is at the lowest rate in decades. What it could mean is that it could be inflationary. So the markets are factoring a definitive rate hike in December, and they're factoring in one more rate hike in 2018, taking up the number to 3 rate hikes in the year 2018, and that is evident in the short-term bond yields, which has gone up by almost 50 basis points from 1.3% to 1.8% in the 2-year paper. Coming to the earnings front, the quarter 2 earnings for Nifty 50 companies, sales, EBITDA and PAT has come in at 11%, 14.7% and 13.4% respectively, which were below expectations. And the numbers were below expectations is because of 2 reasons. One reason is that some of the banks have provided for more NPLs, and also we have seen that the inventory gains which we're expecting for all the 3 OMCs which are listed in Nifty 50 have achieved less than expectation inventory gains. And on the positive side, the numbers which have looked positive are because of again, some of the banks have produced less provisioning, which is added to the earnings. Along with that, there is decreasing competitive intensity in telecom, and the GST benefits, in terms of restocking as well as the tax benefits accrue to some consumer companies. We might close FY18 on Nifty at around 11 to 13% EPS growth, which is good considering the effect which we had in quarter 1 because of GST, and we might see a number of 20 plus in FY19. And the probability of achieving this number is decently high, is primarily because a lot of companies sectors which have been hit by the disruptions are no longer there, and the earnings have become more broad-based now, and we see that the earnings growth is going to come back because of GDP growth coming back and the rebound taking place, which will have a cascading effect across various sectors. So the probability of achieving the numbers of 20 plus in FY19 is pretty good. Coming to the view of the markets, I think the risk return is balanced at this point in time, with growth coming back, but at the same time there's pressure because of oil price increases. So an investor who's looking with a 3 to 5 year horizon with a return expectation of 12 to 13% is ideally suited to invest in the markets at this point in time. And the funds which you can invest are across the table. We have our large cap funds in Frontline and Top 100. We have multi-cap fund, which is Advantage fund and equity fund. We have mid-cap and small cap funds if somebody wants to to take exposure to that category of funds. And we have a host of other thematic funds which one can take advantage of. We have a low volatility fund in the form of Balanced Advantage Fund, and also if somebody wants to invest in a balanced kind of way, then Balanced 95 is there in our staple. On the debt side, though RBI has not cut rates in the recent policy, our team still believes that the current yields, the term spread which is presently quoting at, is pretty high, which means that the yields could cool off, and going forward we could see that the growth slowdown could impact the decision of RBI if inflation behaves itself, and which we believe that inflation could behave itself. There could be a possibility of rate cuts, but patience is the key there. So those investors who are invested in duration, particularly in funds like Income Plus and Dynamic Bond Fund, are required to stay put, or advised to stay put. And other investors, retail investors particularly, those who want low volatility kind of products, should invest in our accrual funds, which are short-term opportunities, corporate bond, medium-term plan. The whole basket is available with you all. Thank you very much, and happy investing.